The world of trading offers countless opportunities for profit, but it also carries significant risk. Among these opportunities and risks are two key concepts: leverage and margin. Leverage, in the simplest terms, is like an amplifier for your trading. It allows you to punch above your weight, increasing your market exposure beyond what your actual capital would permit. Imagine it as a kind of financial seesaw. On one side you have your own capital. On the other, the leveraged amount. This balance can create significant profit opportunities. Margin, on the other hand, is the amount of capital a trader needs to open and maintain a leverage position. Think of it as the security deposit on your leveraged trade. It's the money you need up front to get into the game. These tools can amplify your trading power, offering the potential for higher profits. However, it's important to remember that they also amplify your exposure to risk. Leverage and margin can be powerful tools in the right hands, but misuse can lead to significant losses. Leverage can be a game changer in trading, but it's crucial to understand how it works. Imagine you're at a carnival and you've spotted a strength test game. But this isn't your average strength test. This one has a lever mechanism that magnifies your strength. With the right amount of force and precision, you can ring the bell and win the grand prize. That's what leverage does in trading. It amplifies your trading power, allowing you to handle larger positions than your actual capital would permit. Now let's say you have $1,000 to invest. With a leverage ratio of 10-to-1, you can control a $10,000 position in the market. If the price of your chosen asset increases by 10%, you've just made $1,000, effectively doubling your initial investment. Sounds like a dream, right? But hold on, don't start celebrating just yet. Remember, this is a double-edged sword. What happens if the price of your asset decreases by 10% instead? Well, you've just lost $1,000. Wiping out your initial investment? That's the catch. Leverage magnifies not just your potential gains, but also your potential losses. So just like that strength test game at the carnival, leverage requires precision. It's not just about hitting hard, it's about hitting right. It's about understanding the market, making informed decisions, and knowing when to step back. It's also important to remember that different markets offer different leverage ratios. Forex markets, for instance, are known for high leverage ratios, while the stock market typically offers lower ratios. This means that the degree of risk and potential return can vary significantly depending on where you choose to trade. In the end, leverage is a powerful tool in trading, but it's not a magic wand. It requires a good deal of caution, understanding, and responsibility. It's like driving a sports car. Sure, it's fast and thrilling, but without proper control, you might just end up crashing. While leverage can amplify your profits, it also amplifies your losses. It's a double-edged sword. Margin trading can seem appealing because of the potential for higher profits, but it's not without its dangers. Let's dive into how margin trading works. Essentially, margin trading is the act of borrowing funds to trade larger positions than your existing capital would allow. This borrowed money comes with a catch called the margin requirement, which is the minimum amount of equity a trader must maintain in their trading account. This requirement acts as a safety net for the lender, ensuring they have some level of protection if the market doesn't go as planned. Now, margin trading can be a double-edged sword. While it can amplify profits, it can also magnify losses. This is where the concept of a margin call comes into play. If the market moves against your position and your account's equity falls below the margin requirement, the broker can issue a margin call. This is a demand to deposit more funds into your account to meet the minimum equity requirement. If you can't meet the margin call, the broker has the right to close your positions to cover the loss, potentially resulting in a significant loss of capital. This is why it's crucial to have a risk management strategy when using margin. Risk management can be as simple as setting stop-loss orders to limit potential losses, or as complex as diversifying your portfolio to spread the risk. It's also essential to keep a close eye on market conditions and adjust your strategy accordingly. So while the allure of higher profits can make margin trading seem enticing, it's important to remember that the risks are equally high. It's not a strategy for those who can't stomach volatility or the potential for significant losses. It's a tool, and like all tools, it needs to be used responsibly and with a clear understanding of the potential consequences. Margin trading is a high-risk strategy that should only be used by traders who fully understand the risks and have a solid risk management plan in place. Risk management is not just important when using leverage and margin, it's essential. Imagine you're in a car, driving at high speed. The thrill and the potential to reach your destination faster are undeniable. But what happens if you don't have a functional braking system? That's right, it could lead to a disaster. This is pretty much the case with leverage and margin trading without risk management. So, how do you implement risk management? The first tool to consider is the stop-loss order. Think of it as your braking system. It allows you to set a predetermined level at which your position will automatically close, limiting your potential loss. If the market moves against you, the stop-loss order takes effect and prevents your losses from spiraling out of control. Another strategy is to only risk a small portion of your trading capital on each trade. The exact percentage can vary, but a common rule of thumb is to risk no more than 1 to 2% of your trading account on any single trade. This way, even if a trade goes south, it won't wipe out your entire account. Diversification is yet another important strategy. By spreading your investments across a variety of assets, you reduce the risk of a single investment causing significant harm to your portfolio. Remember, don't put all your eggs in one basket. But perhaps the most crucial aspect of risk management is understanding. Understanding the market, understanding the tools at your disposal, and most importantly, understanding the risks involved. Without this understanding, you're essentially driving blindfolded. It's also worth noting that risk management isn't a one-size-fits-all solution. It's a dynamic process that should evolve with your trading experience, market conditions, and personal risk tolerance. In conclusion, while leverage and margin can amplify your potential profits, they can also amplify your potential losses. That's why risk management is so crucial. It helps you navigate the market's twists and turns, ensuring that you're not just speeding down the highway without a brake system. Whether you're trading with or without leverage, risk management should always be a top priority. Leverage and margin are powerful tools in trading, but they must be handled with care. This is the key takeaway from our discussion today. We've delved into the mechanics of leverage and margin, highlighting how they can amplify your trading capacity beyond the confines of your existing capital. We've looked at the enticing potential for increased profits, but equally important, we've underscored the risks that come with these tools. The threat of substantial losses, margin calls, and the potential to wipe out your trading account are very real. Therefore, we've stressed the crucial role of risk management strategies. It's not just about maximizing gains, it's about protecting your capital, minimizing losses, and surviving to trade another day. So, tread cautiously, educate yourself, and remember that these are tools, not shortcuts to wealth. Remember, trading is not about making quick profits. It's about managing risk and making informed decisions. Use leverage and margin wisely and always trade responsibly.